I see we have a visitor. Who is out there? Can you hear me?
Yes.
Who's this?
This is Robert.
Hi, Robert. How you doing? You're
Good,
in
how are
two.
you?
Good. Yeah, you're one of my 240 guys.
Correct.
Okay. All right. We'll get started in a moment here. We'll see what other kind of traffic we might get. And we have a third party coming on here. I just want to get the names here. Well, that's great. We're right out there in the ocean, huh?
Yeah, right.
And we have Nicole. Hi, Nicole. How you doing? You can hear me, Nicole?
Yeah, can you hear me?
All right. I guess we can begin with a party of three. Robert, Nicole, we got a fourth person coming on here. All right. We're starting to get some traffic. We're supposed to go into chapter 5 today, which is kind of a brief chapter. Um, it's not too much in terms of numbers or accounting. It's more about some of the organizations involved in the world of accounting in the stock market. So let's take a peek here. And if you like, we can also go back to chapter 4 on the adjusting entries. So let's see if we can get started here. Let's see if we can find this thing here. Okay, I trust we can all see the PowerPoints, everybody, right? Okay.
Yeah.
All right. All right. Chapter 5, you get a flavor of this here. Communicating and interpreting. Wow, look at all this, huh? Management is responsible for the financial statements. The auditors verify. When I say verify, they just will render an opinion, hopefully an unqualified opinion, that the financial statements are prepared in compliance with GAAP, generally accepted accounting principles. They're not necessarily saying that the statements are correct, because they're relying on the information that the company is providing, and they verify it as best they can, huh? Information intermediaries, financial analysis. These are different people who are involved in the process. And the users, who uses the financial statements? Investors, lenders, and certainly the company. The company needs to know how well they're doing. Employee bonuses might be based on the financial statements. Sales projects, salespeople need all this information. So the players in the process, the regulators, the SEC, Securities and Exchange Commission, started in 1934 after President Roosevelt was elected during the throes of the Great Depression. And for the first time, companies that put their listings up in public on the stock market have to have audited financial statements, and it provided some protection for potential investors. FASB, Financial Accounting Standards Boards, they're part of the American Institute of Certified Public Accountants. FASB, they're the ones who come up with the rules. They're the ones who decided that revenue is recognized at the point of the sale, not having anything to do with the cash. They make up the rules. And then we have management responsibility, which we just talked about. These are the key players here. Every major corporation has what we're going to call a board of directors. The board of directors of a company, typically around 9 people, can vary. The board of directors has one of many responsibilities to assign an audit committee. The board of directors hires the auditor. The board of directors should be a mix of people who work for the company and external people with a neutral eye to what's going on. They hire the auditors and monitor what they're doing. The auditors come in, they are external to the company. The auditors come in and they verify what they can on the financial statements and render an opinion. You can have internal auditors too, but they're hardly independent. I mean, they're very useful to the company to make sure they're doing things correctly and in accordance with the rules. But the internal auditors cannot say, "Hey, we're great. We did everything correctly." It's the external auditors who have that responsibility. Okay, we just saw this annual reports, and we're kind of going a little bit back in time here, but we have privately held companies, and they have four basic reports: income statement, statement of equity, balance sheet, and the cash flow statement. Four basic statements. What's real important in these financial statements are the footnotes or the notes. Every line item on the financial statements is going to have a note. It could have some big notes. For example, you might see under accounts receivable, page after page explaining their credit policies, the risks that they see involved in collecting, their policies in terms of writing off bad debts. So the notes are quite important, and the report of the independent auditors if they're audited. So the annual reports have the footnotes and the opinion of the auditors. When I was taking the CPA exam many years ago, it was recommended we memorize the qualified opinion, which I no longer remember, but it goes along the lines: we have examined the financial statements of City College, and based on our application of procedures and analysis, we render an unqualified opinion that the statements are issued in compliance with GAAP. Annual reports. There's a non-financial section, and I'm going to interrupt myself. Has Cornelia talked about the FSAs at all yet? Has she assigned two companies yet for you to do with the FSAs? Okay, so you're waiting for that. I'm not sure. I'm going to check with her today if she wants me to give you the two companies. The annual reports, which you'll be looking at like crazy on your FSA, has a large non-financial section. The annual report is half factual reporting to the public and half puffery, if you will, half informative in ways beyond the numbers. It'll include what they call a letter to the shareholders, a description of management's philosophy, and it usually says something like, "Well, 2019 was a great year for us, blah, blah, blah. Here we ran into some problems. Here's what we're looking for in the future." And of course, this financial section. And there are minimum disclosure requirements. They have to come up with the four financial statements and some other things. The annual reports. They'll typically have all kinds of pages where they're comparing past years. There'll be a discussion of management, the statements. They'll have information on the stock price. You'll go into their annual report and you'll see what the stock price has been at the end of every quarter, probably for this year. It'll show what the stock price has been in the past, and they'll have all kinds of narratives on what they think might happen. They'll have summaries of the unaudited quarterly data, and they always love to list the directors and the officers of the company and relevant addresses, not their home address necessarily, but places where you can write to them. And this is always interesting to me because they reveal their salaries and their bonus package and perks. So that's kind of interesting. If you see a company is not making much money and you're disappointed that you did not receive a dividend, and you look here and you see that the board of directors rewarded the president of the company and the CEO with gigantic raises and bonuses, you have a right to beef. Quarterly reports, they're called the 10Q. They're the same thing as the annual report. It's shorter, obviously, has that letter. Now we'll have some unaudited income statement and balance sheets because we're not at year end. January, February, March. Here's where the company stands right now. These items have to be sent into the SEC, even though they are unaudited, and cash flows and equity statements could be omitted. And it's just a smaller look at the business when we're talking a quarter. The auditors, independent, right? These are the outside guys. What you're looking for is an unqualified or clean opinion. We determined that this company has done everything according to GAAP based on our generally accepted procedures and tests and conversations with people. Okay, unqualified. The financial statements are fair representations in all material respects in conformity with GAAP. It doesn't really mean that the statements are correct. It doesn't attest to that. It attests that from their tests of the information that they were given, they were able to come up with called an unqualified opinion. For example, company says we have $1 million. First thing the auditors will do is to show me the number in your general ledger. There it is, balance of $1 million. The company will then say, show me some of the transactions, and they'll highlight some of those transactions. And they'll contact the bank. They'll say, Bob's company says he has $1 million on this date. Is that right? They'll do all kinds of tests and interviews and whatever they feel is appropriate. And based on that, they'll render this unqualified opinion. Now, if it's a fraudulent company and they're in cahoots with somebody at the bank, or the bank is crooked, which is exaggeration, but I'm trying to make a point here. The auditors cannot be expected to find that type of thing. And thus, management is responsible for these statements. 10K, 10Q. These might be a multiple choice question on the test. I'm not sure. The 10K, this is the big one. It has to be done within 90 days of the fiscal year end. And this is the big guy. When you go in there with your two companies, you're going to be looking at that 10K like crazy. You're going to be looking at that 10K to find the balance sheet and the income statement and come up with the calculations you need for your FSA, the financial statement analysis. Then there's a quarterly 10Q due at the end of the quarter. And these, like we just said, are unaudited. And then the 8K is due within four business days of the major event. The 8K of a major event. I'm going to skip over that one because I'm not an expert in the 8K. I also don't think I've ever seen it pop up in your testing, but I'll double check with Cornelia. Here is what they call a classified consolidated balance sheet. A classified balance sheet means that we're separating the current assets into one group away from the long-term or fixed assets. Current assets we expect to get the benefit of within a year. Cash, we're spending cash every day. Cash is a daily thing. Accounts receivable, we expect to get paid within a year. We expect to sell our inventory within a year. And we have prepaid assets and some other things, huh? So in these 10Ks, these quarterly reports, the annual reports, you'll see comparisons from year to year. You'll see here that this company's Callaway Golf, they manufacture clubs and equipment. Cash, current assets went up. And let's see what happened with current, skipped over that. How did we lose that? Current assets, you can see they went from 438 to 493. Okay, that tells us a little bit to get started. And their liabilities really went up quite a bit. So maybe in the notes to the financial statement, they'll point out payables were pretty steady. We didn't take on any more debt with customers or suppliers than we normally do. We're controlling that. But the reason it went up was they borrowed money. They borrowed money. They borrowed $80,000, and they may have borrowed more than that, with the rest sitting down here as a long-term part of the note. And this note will explain in the annual report why they borrowed this money, what the terms of the notes were, what the purpose of the loan was, when they expect to turn it back. So the point I'm trying to drive at is you have a lot of extra information in your annual reports. And your comparative balance sheet continues with the equity statement, huh? And looks like here they didn't do anything with common stock. Paid in capital went down and retained earnings went up slightly. So they looks like they made money, and I'm assuming they have not paid any dividends at that point. Classified income statement. This too is going to be mixed in with certain types of categories. You're going to have sales, and you're going to subtract cost of goods sold to get what's called gross income, minus operating expenses will give you operating profit. So let me stop babbling and show you, okay? Companies may have non-recurring items. These non-recurring items are things that are not part of the operation of the business. These are unusual things, usually one at a time type things. And the best example I can give you here is discontinued operations. Coca-Cola, my favorite company, right, has bottling plants all over the world. They have all kinds of satellite places. Well, if they shut down a factory, say in Brazil, that is called a discontinued operation. And shutting that factory down does not belong in your operating expenses or any income they may get out of it. Discontinued operation. They're going to have to put that down below the operating income. These are called extraordinary items. Extraordinary items is an accounting term for these one-of-a-kind type things that occasionally happen. The sale of a fixed asset until fairly recently was considered an extraordinary item. That's no longer the case. They're reported separately. They have nothing to do with helping the shareholders understand the business. We shut down a factory in Brazil. Well, we want to know what happens after that. This is your little template here. Your little template. And I've been when I teach this over the years, I like these silly mnemonics, and I'll give you one in a moment. But net sales minus cost of goods sold equals gross profit. Gross profit. Net sales minus COGS equals gross profit. And I'll tell you what cost of goods sold is again, because I think there's still some confusion out there. Cost of goods sold is the amount you paid for the merchandise you just sold. You sold a garment at Nordstrom's, you sold a garment for $1,000. That is your net sales number. You paid 6 months ago, maybe, you paid $400 to buy that garment from the seamstress. That is your cost of goods sold. It's one expense and one expense only. It's what you paid for the merchandise you brought in. And cost of goods sold is recorded only at the point of the sale. When you sell something, that's when you record the cost of goods sold. You're going to have a 4-line journal entry. You're going to debit accounts receivable, of course. You're going to credit sales for the 1,000. If you paid $300 or $400 for that garment, you're going to debit cost of goods sold to show that expense and credit your inventory. Excuse me. And from gross profit, we subtract operating expenses. Operating expenses are broken out into selling expenses and general and administrative expenses. Gross profit minus operating expenses. Operating expenses are just what they sound like. They are the expenses that a company normally incurs in running their business. Has 2 categories we'll show you, I hope, shortly. Selling and admin. Selling expense is the salaries of your salespeople, commissions, advertising, the benefits that those people might have, the rent on their office, their company car. General and admin would be the accounting department, the purchasing, the managers of the company. Income from operations. This is the part that is controllable by management and employees. Sales down to income from operation. Non-operating revenues have nothing to do with running the company. And what we're really talking about there would be things like interest income, interest expense might be something. And then we're going to get our income before taxes and subtract the taxes. So let's see if this thing doesn't go into any real detail on this. Here's a mnemonic I've been using for a long time. Some clowns get silly at night, huh? Some clowns get silly at night. Sales, some clowns, cost of goods sold, get gross profit. Some clowns get silly at night. Selling, admin. Some clowns get silly admin, night, net income. That's a mnemonic, and hopefully you're pretty close to not needing some of these, but they can be helpful. I have another one I use in 240. Some clowns get silly at night. That's the template for your income statement. So if you have that template in your mind, when you're taking the test, you might get a question like, the gross profit was 100 and the net sales were 800. What was the cost of goods sold? And in reading those kinds of problems, you might get confused. But if you say to yourself, oh, well, I know that, sales minus cost of goods sold is gross income, the difference would pop out there. Okay. Earnings per share. When you do your FSA, you're going to be coming up with all these different metrics. And this is one of the most important ones that people look at when you invest in a company. Earnings per share. Net income divided by the outstanding shares. And if you're flipping the channels, even if you're not the least bit interested in the stock market, but you're flipping the channels and you happen to come to the news, you might hear somebody say, Microsoft announced earnings today and they met their target of $3.45 per share, earnings per share. Net income divided by the outstanding shares. If your earnings per share is, say, $3.50, that means that they had $3.50 of income for every share of stock outstanding, meaning the shares that are owned by the public, you and me. So if you're a shareholder of a company and you see the earnings per share are $3.50, you might say to yourself, hey, I'd like to get a piece of that in the form of a dividend, something you might look forward to. And if there's preferred dividends, they get cut out of this calculations. We have a whole big chapter coming up on common stock and preferred stock. But when you're talking earnings per share, we're talking common stock. I like this heading here, common-sized income statement. Well, here we go. Your sales right here. Here's your your sum, right? They have this company has two kinds of income. They have their regular sales, and maybe they rent out part of their building to somebody. Excuse me. So total revenues, and here you can get a look at various percentages. Total revenues, 69.8. Cost of goods sold, they sold $66,000 worth of clothes. They paid $36,000 to buy those clothes. And then you get your selling and admin expenses here. Your salaries, here's your G&A. You got depreciation, operating income. Operating income. After that, these are the items after operating income that are not really controllable by operation type managers. And they're giving you some examples here. Investment income, interest expense, maybe interest income, gain on a sale of land, that's no longer correct there. and you come up with net income. And they're even giving you the 40 cents per share. I'd like to take you through the percentages. Your first FSA is called component percentage and trend line analysis, I believe it's called. Component percentages. You see all these percentages to my right? They all represent a percentage of sales. Net sales, not gross sales, net sales. Net sales are 100%. $36,000 divided by 69.8 equals 51.58%. So you can see that over half of their expenses are related to purchasing inventory. Okay, makes some sense? You guys interrupt if you find me babbling and you're not quite following. Jump in there with questions or comments. So cost of goods sold is 51%, salaries and wages, etc. All of these numbers here are the elements divided by the net sales, your total net sales. Okay, so their operating income, 7,200 divided by the net sales is 10.32%. That means for every dollar this company generated in sales, they earned 10 cents. Make sense? This company had operating income, 7,200 divided by that, comes out to 10.32%. So they generated a dime for every dollar of income, 10.32%. That sounds like a pretty good number to me, just off the top of the head, not knowing the business, not knowing the industry, not knowing the expectations, not knowing what their competitors have done. 10%. If they chose not to run the business, they would ended up with less than 1% if all they did was put the money in the bank. Operating. This whole section up here, this is what's controllable by the workforce. You have the ability to generate more sales, or at least attempt to. You can lower your price, you can raise the price, you can do different things. You can spend money as you choose to advertise, hire the people you want. You decide what you're going to pay for your goods, where you're going to buy them. This is all management control. This stuff below operating income is not. But you continue along with the same calculation. So we earned operationally 10 cents. And after these guys are considered, we actually made a little bit more. We made half a penny more. And that's because we had some investment income. We sold a piece of land, and that exceeded the various other type expenses. So this company, they earned 40 cents a share. Some people don't want dividends. Some people get mad if they get a dividend. It seems silly to be angry that you got a check in the mail, but you might not want a dividend. You might prefer that company not give you the dividend, but reinvest it and drive this stock price up where you can really make a killing one day. Okay. Statement of cash flows. Again, we're not going to go into this in any real detail because there's an entire chapter on the statement of cash flows, the indirect method specifically. Just understand the three types of cash flows now. Operating. That's this information above operating income. This is what the normal business does. They buy things, they sell things, they pay their employees, they pay for the utility bill, they get to recognize wear and tear on their machinery. That's all controllable by management. Operating. Investing, we're really talking two things here. Investing. You bought a big, expensive fixed asset for big money. You bought a $1 million machine that's going to stamp out finished products for you, hopefully for the next 20 years. That's not an operating item. That is an investment. Or you bought stock or a bond of another company. Coca-Cola has plenty of money sitting around, and they decided to buy Microsoft stock. That would be an example of them investing. And I'm going to digress a little bit here on my state of the economy speech real quick. Companies are still hoarding cash right now due to the uncertainty in world affairs, not knowing what's going on with interest rates. And when that money gets freed up, it should really help us get back on our feet here, economically wise. It's just a little editorial. Cash flows from financing. Financing is borrowing, basically. Borrowing. You're raising money by getting a loan from a bank, or you're issuing a bond, or you're issuing stock. Financing. So that's pretty much what we have to do right now in terms of cash flows. You'll have fun in chapter 11 or whatever it is when you put that big indirect cash flow statement together, but that's a ways off. Let's just take a quick peek at the cash flow statement here, okay? This is a real poor man's quick look at it. But what you're going to do here, and I can't quite see on the bottom. Give me a chance to move this over if I can. Oh, for Pete's sake. There we go. I think I can see it now. Oh, it's not set up the way I want. But the cash flow statement, you're going to take the income to start. And you're going to add back your non-cash items like depreciation, amortization, non-cash. Why you do that is because you're taking the net income, which, as we all know, is on an accrual basis, and by adding back the depreciation, amortization, you're going to turn that into a cash basis income. And then you're going to look at your balance sheet and put these differences in. I don't think we really need to look at this slide in any real detail because you'll be doing this in chapter 11. The key point I'd like you to know, though, is you take the net income plus your non-cash items and come up with a cash-based income number. Again, this is not the cash flow statement presentation I'd like to go over here. I'll talk a little bit more about it because it's here. Income plus the non-cash gives us a figure. Accounts receivable, you see a negative number there? That means that accounts receivable went up. Why is it a negative cash flow if accounts receivable went up? The answer is the only time accounts receivable goes up is when we give away our product to somebody. It means we sold product and didn't get any cash for it. When our customers pay us, cash goes up and receivables go down, and that's a positive cash flow. Same thing with inventory. If inventory went up, that's not good cash flow wise. It's an unfavorable cash flow when you sell it. Again, I'm getting ahead of the class here. So this first page, I like to call your attention to this number, 17,287. This is how much they earned, how much cash they generated positive from operations. But look at this. They have a section called investing where they spent money on some fixed assets or whatever. They bought stock. Negative cash flow from doing that. Positive cash flow from borrowing. You add those three numbers up and you come to a total cash flow of 46,362. Your cash change went down by 3 million. So you had cash flows of that difference there, $3 million. The boss will come out and start yelling at you. How come we lost 3 million? How come we we spent 3 million more. And you say, boss, don't forget we had a very positive operating cash flow. Boss, we generated 17 million, but don't forget we did a lot of investing. And the boss goes, oh yeah, now I remember. That might have been way too much on the cash flows. The notes to the financial statements, descriptions of the accounting rules. Cash. You would think cash is pretty simple, right? Well, you look at a large company's balance sheet in a little bit of in a little detail, and the notes are going to show you that they have cash in a checking account. They have cash maybe in a payroll account. They've got long-term CDs, short-term CDs. They've got all kinds of cash in different elements, and they're going to describe all of that for you. You're going to have a lot of details supporting numbers. You're going to see a sales number of $1 million. You're going to see page after page of an analysis in the notes. You're going to see how much of that was sold in the United States, how much was international, how much was this type of product, etc., etc. The notes show relevant financial information not disclosed on the statements. If you're getting sued by somebody and you're not sure if you're going to win or lose that lawsuit, maybe you don't put it on the financial statements yet, as you're going to learn in 2 chapters, but you have to disclose it. We are being sued by a competitor for a patent infringement. Our lawyers are studying the issue now, and at this point, we're not ready to decide whether we may or may not lose. Just a very simple type of note, huh? Accounting rules. Here's a good example of a note. Here we go. You had a number on your financial statement for property, plant, equipment. Could have been $10 million, whatever. Here, one of the first notes, property, plant, equipment are stated at cost. We should know that, right? Everything on your balance sheet is at the historical cost and will stay at that cost forever on your financial statements. But we are depreciating it. Cost, the original cost, less depreciation is book value. They're just telling you they do that. And they're giving you a little clue on their straight line, on their method of depreciation. In this case, it's straight line. And they're showing you their assumptions for useful lives. This may or may not be of great interest to an investor. I don't know. The point is, these kinds of notes are there for the investor. Companies can't give out enough information. They want to give out as much information as they can to be as transparent as they can, and they want people, the public, to rely on their financial statements and maybe buy their stock, huh? And this is all about their depreciation methods here. The second category of notes is just what I was talking about. Sales. Sales. Well, this company had $1.7 million in sales. And let's see here. Well, just over half of it are domestic sales. They have a strong presence in Europe and Japan and the rest of Asia, and then other foreign countries. People want to know this. You have a company that sells a consumer product that's popular in the United States, and you see they're doing very little international sales. That might raise a question. Are they missing an opportunity? The financial statement notes might address that. They'll say something like, sales to Europe were only $1 this year, but we have just started to hire a sales force out there. We've opened up a distribution center. The notes will give you this type of information so you, the investor, can make the decision whether or not to invest in this company. And they're just showing you long-lived assets. I guess those are fixed assets. And nearly everything is in the United States. What types of things are not disclosed on the financial statements, but are probably going to be shown in the notes? Information that affects the company, but they're not in the financial statements yet. Well, I'm just going to go back to that one example, lawsuits. When you get into chapter, let's see, we're at 5, chapter 7 is about liabilities. You're going to learn that if we get sued, there are 3 possible treatments. 1 is to record the lawsuit because we think we're going to lose it. 2, ignore it completely because it's a frivolous lawsuit. The one in the middle is the one that's going to be on your financial statements. We are being sued. Our lawyers think we have a pretty good shot at winning it, but we're not sure. That's the thing you put into the notes. Return on assets. This again, you're going to be doing this with your financial statement analyses. You're going to take your net income and divide it by the average total assets. And when we say average total assets, we mean the number of the amount of assets she had on December 31st, year one, plus the assets at the end of year two divided by 2. And this is another measurement investors and lenders and people want to see. It gives you an idea. What did you get out of all these assets you bought? You bought all this equipment. You've got all that cash sitting there, inventory, prepaids. And here we go. Callaway Golf over a 3-year period went from 2.9 to 6.5 to 7.8. Okay. It looks like the golf business did very well in these periods here. Either they had more income or they were able to kind of reduce the asset number down. That you would find by looking at the balance sheet and in the notes. So this means, for example, we'll look at the big number. In 2008, dividing their income out by the total assets, they earned 8 cents in income for every asset they have on the books, on their general ledger. 8 cents. That might be good, that might be bad, depending on the situation. 8 cents. If they had invested this money here in a bank today, they would not even get 1%, huh? So by taking a risk and running a company, they have done much better. And this gets a little more complicated later on. But again, I'm going to just go over it briefly. Return on investment, huh? Return on investment. Return on investment. How do I want to say this clearly? You bought a stock for $100, and it gave you a $10 dividend. That's a 10% return. That would be your margin. Company has a net profit margin. We looked at it before. It was something like 10.1%, if you recall. We multiply the margin by the asset turnover, which you haven't seen yet. The asset turnover. Return, ROA, return on assets. Return on assets. We just came up with this number here of 7.8. They got that number by taking their net margin, their net profit. I don't say margin. Net profit's a better word. Net profit times the asset turnover. So your return on assets is this number here. That's what we just calculated. And another way to say it is it's your net profit times the asset turnover. Little simple arithmetic here. I see net sales here. I see net sales on top of the line. Eliminate those two items, and there you go. Net income divided by average assets equals this. And again, we have a lovely chapter on that coming up. Profit drivers, let's see what we got it. Rely on R&D, low cost. What is this here? High value or product differential, rely on R&D, convince. Okay. Here, this is a company. This is a company that does a lot of advertising, like those ridiculous and annoying insurance commercials you see. There's not much difference between the service or the product. So they're relying on research and development maybe to come up with something, or in lieu of that, promote. Or they can have a low-cost strategy where you internally manage these assets. You rely on efficient management of accounts receivable, inventory to produce high asset turnover. Accounts receivable. You sold $1 million to the world, but over half of your customers went bankrupt and never paid you. That's poor management. You took too many risks in generating those sales. Inventory. You want inventory to be as low as possible. In a perfect world, you'd have zero inventory at the end of every day because you have such control of your operation that you order only what you need to meet that day's demands. In the summer of 1989, my boss sent me to a seminar at the University of Tennessee, and we toured the brand new Nissan plant out there. And basically, at the end of the day, that floor was pretty much empty. It was quite amazing. They would open up the next morning, say, and you'd open up the factory, and they would have just the inventory they needed there that day. Their vendors had to come in there every day and deliver on a very JIT basis, just in time. Low cost strategy. Chapter supplement, non-recurring items. Yeah, we should go over this just a little bit. Not another word for the extraordinary items, we can call them non-recurring. Things that are unusual, and they have nothing to do with operating the company. They have nothing to do with operating the company, but it sure affects the bottom line. So we report these separately. If you mix these all up in here, investors could get very confused. Suppose you had a non-operating revenue because you sold some fixed assets. You sold some fixed assets. Your gross profit was, say, $1 million, but your gross profit was a loss of $1 million, but you sold $2 million worth of fixed assets, which made the profit look much better than it really was. I said gross profit. That's incorrect. I'm gonna say it correctly this time. You broke even, say, on income line. You pretty much broke even. But you sold a bunch of fixed assets, which has nothing to do with running the business. If you put it up here with your operating part, as part of your sales, if you will, people are going to think you're a profitable company when you're really going out of business and you're liquidating. So that's why they have these different classifications. Discontinued, the sale or abandonment of a segment of a business. A department store might close a location. It's very sad when Macy's closed downtown, okay? Well, when that happened, Macy's sold the building, perhaps, if they owned it. They sold whatever merchandise was there, or they moved it to other stores. They might have had to pay off their employees up to a certain point. That gain or loss has nothing to do with running the business. It goes below the line, as we say. Below the line. Extraordinary items. Extraordinary. So here's a little presentation of the income statement now. Operating revenues minus the operating expenses gives you operating income. And then you have some of this other information here. We had equity from an unconsolidated business, other expense. This could have been interest expense, tax expense. Well, there's interest expense, minority interest. So income from continuing operations, okay? This is your operating income. And this we might call the net income minus the taxes gives us net income. But we had this oddball stuff here. We discontinued an operation, and we actually, looks like we made money on discontinuing because maybe we sold the building and you had some other items. So our bottom line income is $5,521,000. But if you're an investor in this company, you wouldn't be looking at that. You're not going to look at this number necessarily. You're going to be looking at this nice $9,492,000 number. This is what they're doing operationally. You divide 9 by 91, that comes out to about what, 10 cents a share. These guys, 10 cents they're driving for every dollar of revenue. And now we can go boating. I got to go wax. That reminds me, I got to wax my surfboard. I got to get out there later. Any, who's smiling at that? I see silly smiles.
Me,
Anybody
I'm
have,
20.
hi, Corey, good to see you. Any questions, anybody? Is there something you'd like me to talk about in terms of the adjusting journal entries or other things? This chapter here is kind of an outlier in that there's not much to do in terms of actual recording of transactions and things. You okay with this, Nicole?
Yeah.
Making Nicole speak. Who else is out there? Anybody else want to say hello? No? We have a pretty big crowd. Oh, Robert, hey, you're back again. Make some sense, Robert?
Yes, I did. Thank you very much.
Go, hi, Maria. How you doing?
Good, thank you.
Good, good. You getting ready for your exam?
Huh?
When is our test?
It's in 2 weeks from now, I think.
Okay. All right. Well, you know where to find me for tutoring, me or Ellen, huh? And one last thing I have to say, the New York Jets stink. We know that, right? They lost again. New York City could have two football teams that do not win a game all year. The Jets and Giants could go 0-32. So you can see where my mind is, huh? Okay, no questions. I'll let you fellas go, all right?
Thank you.
Hey, you're welcome. You guys
Thanks.
you enjoy the rest of the week, huh?
You
We'll
too.
see you Friday. Bye-bye.
Hello.
Bye.
Excuse me.
Question, Robert?
I just had one question.
Sure.
I might have missed it in the past. I know it's probably been talked about, but how is the test going to be formatted?
It's going to be online, first of all. It'll be in the form of multiple choice questions, true or false.
Okay. Is it through Canvas or is it through the McGraw-Hill education?
It'll be it's McGraw-Hill Test Bank is where it's coming from. And the teachers select the questions. And that's a question you really need to post to Cornelia. Because the way we're splitting this class is I'm pretty much just the teacher, if you will.
Okay.
And that's why I asked you if you had been given the two companies for the FSAs.
Okay.
If she wants me to do that, I'll be glad to hit you with a couple. So I would just shoot off a quick email to Cornelia.
Perfect. I appreciate it.
Okay.
Well, have
Anything
fun.
else?
No, I think I'm good. I appreciate it.
Okay. Goodbye, everybody.
Bye.
We'll see you in church, as we say. There we go. End me.